Affordability still is the biggest obstacle that our people are having. And that's just because appreciation went up so quickly, so fast, and income didn't meet those paces. So now, what can happen to truly have affordability come a little bit more in line? There's three things: interest rates going down, incomes going up, or housing prices go down. Now, what's the most likely scenario? Maybe all three. Incomes have been outpacing appreciation. That has happened. So income's been going up a little bit, like 3%, 4%, whereas appreciation has been 1 to 2%. Welcome to the Real Estate Show with Pat Lopez, where we talk everything real estate. For this show, we're going to be talking about interest rates. Are they dropping? And what will the new Fed President, Kevin Warsh, do? Now, let's jump right into the interest rates. You may have heard there is a peace agreement, or at least an outline of a peace agreement in the making. J.D. Vance, the vice president, is flying out to Switzerland to sign this outline of an agreement. Now, we have seen that the interest rates have started to come down a little bit, very little. The 10-year Treasury got a little bit better, and the 30-year fixed mortgage have gotten a little bit better. But this is going to be a slow pace move, because like anything, the Straits of Hormuz is going to be open, oil will be flowing, so that fear of inflation will go down a little bit. But like anything, when you fill up a bathtub, you turn on the water, the tub isn't full. It takes a little time to fill it up. Well, same thing with oil. The moving of these big tankers moving back and forth, and this oil to get to the location, it's going to take a little time. So it will be a slow haul to be able to get some of that inflation pressures down. Now, we don't know if something else won't arise. Something else could happen. We could have great job numbers come out. We could have pressure on incomes, meaning they go up a lot faster than anticipated, and the Fed gets a little bit nervous. So there's a million things that could still happen, but right now the markets are liking this outline to this peace agreement, and hopefully interest rates will start drifting down. Are you thinking about buying, refinancing, or investing in real estate? I've been a loan officer for 30 years, helping my clients find the right loan for the right property. I keep it simple and honest. If you want real numbers and guidance you can trust, give me a call. Now let's get back to the show. If we go back and we look at last year, around the same time, or let's just talk about from January on, interest rates were much higher. We're talking about anywhere between 6 3/4 to 7 1/4. Now, if we look at this year, January, we started out with interest rates in the high fives. And once again, this all depends on what kind of loan you're doing, what interest rates you have. Is it a single family? Is it an investment property? Is it a multifamily? There's all the bells and whistles that come into impacting of rates. But in general, that's where interest rates were. So right now, we're looking at interest rates really never getting above 6 3/4. Now, hopefully, interest rates can drift back down to be in the low sixes, in between 6 1/4, 6 1/2, which would help with the affordability. And really, the affordability is the issue that we have. Now, if we look at appreciation of homes during the COVID years, we're talking about 30, 40, 50, 60% appreciation on homes. Nobody's income caught up to that. You know, you didn't turn around and go into work and you were making $30,000 and a year later you were making $60,000. I mean, some people, yeah, you know, if you got raises or what have you, but for the most part, no. So affordability still is the biggest obstacle that our people are having. And that's just because appreciation went up so quickly, so fast, and income didn't meet those paces of it. So now, what can happen to truly have affordability come a little bit more in line? Well, there's three things. You know, we're talking about interest rates going down. We're talking about incomes going up, or housing prices go down. Now, what's the most likely scenario? Maybe all three. Incomes have been outpacing appreciation. That has happened. So income's been going up a little bit, like 3%, 4%, whereas appreciation has been, 1 to 2%. So incomes have been going up a little bit faster. So if we can get the interest rates to come down like we were in the beginning portion of the year, and we turn around And maybe we get a little bit, more inventory online. And in the South, they've been seeing that, whereas in the Northeast, we haven't. So we're going to see, but you're going to need a combination of all these factors to really have affordability come in line, because just income appreciation isn't going to do it. Just, unless housing prices truly collapse, which isn't going to happen. There's just not enough inventory for that to happen. So the house that's 300,000 all of a sudden drops to 150. That's just not happening as far as it. So it's going to take a combination of all three to really move the needle. But hey, maybe with this agreement outline in place, maybe we can start getting interest rates a little bit lower. We started out the year good, especially with a lot of momentum with buyers and sellers. And so we're going to see how that moves forward. Now, let's go into Kevin Walsh. We have a Fed meeting coming up Wednesday, which by the time this airs, it would have passed. But right now, there's like a 98, 99% chance the Fed will not change rates. But they've already built in rate increases, not decreases. When we first started in the year, they factored in, the Fed, 2 rate cuts. Right now, they're factoring 2-3 rate raises, not cuts, to actually raise the interest rate. Now, with this agreement outline, maybe they won't have those increases, and maybe they'll just stay neutral, where, hey, we're going to leave everything where it's at. Now, the million-dollar question is, the peace agreement going to hold? How many times have we heard, oh, there's a peace agreement where they're going to sign, they're not signing, back and forth, back and forth. Then all of a sudden, missiles flying, all that kind of stuff. So nobody knows what's going to happen as far as that's concerned, but hopefully, the agreement will hold. Nobody wants death. Nobody wants, starvation, because now you're not allowed an import of foods and all sorts of stuff. There's nothing good when it comes to war and conflict. So hopefully that can sort out, and oil can freely flow. Iran can get ships coming in. They can trade, and they can come to maybe a more normal lifestyle as far as that is concerned. But we're going to see. We're going to see what Kevin does. We're going to need to listen to the minutes and the interview afterwards of the tonality, because that really is going to impact moving forward where rates are. If that tone is, hey, we're still going to really monitor and maybe still raise interest rates, but that's not going to be good for the mortgage rates and housing, because, hey, we know once we pierce that threshold of 7% and higher, boom, real estate just stops. It just becomes too unaffordable for the average person. So wanted to talk about, hey, this agreement or the outline of agreement is there. Hopefully it will hold. Hopefully interest rates will slowly start creeping down, because remember, last year, the end of June is when interest rates finally got below 6 3/4 and started working its way down all the way through December and January, where we ended up getting in the high 5s, once again, depending on the program that you did. Well, there's my little update, some thoughts. Hopefully you enjoyed this podcast. Remember, follow the show on Instagram, Facebook, and of course on YouTube. We always air on YouTube. The Real Estate Show with Pat Lopez. Well, leave your comments, and I'll see you next week.